In this video, we will show you 3 AI infrastructure stocks you can buy right now while they are still trading at a discount. These are businesses building the infrastructure that powers the entire artificial intelligence revolution, and today you will discover why the market may still be underestimating their long-term potential. As AI adoption accelerates across every industry, the biggest winners are likely to be the companies supplying the critical technology that makes it all possible. These businesses enjoy powerful competitive advantages, enormous demand, and the kind of long-term growth that can compound shareholder wealth for years. Let's begin with the first stock. The first company on our list is Broadcom, ticker symbol AVGO. If artificial intelligence is going to reshape the global economy, companies will need more than powerful processors and advanced memory chips. They will also need custom silicon designed for their own AI workloads and networking technology capable of connecting hundreds of thousands of processors inside massive data centers. That is exactly where Broadcom has built one of the strongest competitive positions in the semiconductor industry. Broadcom is much more than a chip company. It has quietly become one of the most important architects behind the next generation of AI infrastructure. While many investors focus on companies producing graphics processors, Broadcom has been positioning itself behind the scenes as the company enabling some of the world's largest AI systems to operate at scale. What makes Broadcom especially attractive is that it benefits from multiple parts of the AI infrastructure build-out instead of relying on a single product category. Its first major opportunity comes from custom AI chips. Not every company building advanced artificial intelligence wants to rely entirely on off-the-shelf processors. Some organizations require chips optimized specifically for their own software, workloads, and data centers. Custom silicon can deliver better performance, improved efficiency, and lower operating costs for specialized AI applications. Designing those chips is incredibly complex. Very few companies possess the engineering expertise, manufacturing relationships, and intellectual property needed to create them successfully. Broadcom is one of those companies. That leadership has allowed it to become the preferred partner for some of the largest AI infrastructure projects in the world. The company helped co-develop custom tensor processing units, giving it an important role in one of the fastest-growing areas of artificial intelligence computing. But Broadcom's opportunity extends well beyond one customer relationship. Several hyperscale AI developers have turned to Broadcom to help create their own custom AI chips, dramatically expanding the company's long-term growth runway. This is important because custom silicon is becoming an increasingly attractive option as AI workloads diversify. Different AI applications require different hardware optimizations. Some prioritize training enormous foundation models. Others focus on inference, real-time reasoning, recommendation systems, enterprise automation, or agentic AI. Instead of forcing every customer to use identical hardware, Broadcom helps design solutions optimized for each company's specific needs. That creates deeper customer relationships and significantly higher switching costs. Once a customer builds its entire AI infrastructure around custom silicon, replacing that technology becomes both expensive and disruptive. Those kinds of long-term partnerships often translate into years of recurring revenue and continued engineering collaboration. Management clearly believes this opportunity is only beginning. The company has projected that its custom AI chip business alone could exceed $100 billion in annual revenue by fiscal 2027. That is an extraordinary number. And considering how quickly AI infrastructure spending has continued accelerating, even that projection could eventually prove conservative. But custom chips represent only half of Broadcom's AI story. The second major growth engine is networking. This is one of the most overlooked areas of artificial intelligence investing. Imagine a modern AI data center containing hundreds of thousands of processors working together simultaneously. Those processors constantly exchange enormous amounts of information while training increasingly sophisticated models. Without ultra-fast networking, those expensive processors would spend valuable time waiting for data instead of performing calculations. In other words, faster networking directly improves the productivity of every processor inside the system. Broadcom has become one of the industry's leading providers of advanced networking technology used inside these massive AI clusters. As AI data centers continue growing larger and more complex, networking becomes increasingly critical. Each new generation of infrastructure requires higher bandwidth, lower latency, and greater reliability. That creates another powerful long-term tailwind for Broadcom's business. One reason I like this investment is because it does not depend on any single AI trend remaining dominant. Whether the future belongs to larger language models, autonomous AI agents, enterprise automation, robotics, or scientific computing, every one of those applications requires powerful networking and increasingly sophisticated silicon. Broadcom participates across multiple layers of the infrastructure stack, That diversification helps reduce risk while expanding the company's addressable market. Another encouraging development is that Broadcom's traditional businesses also appear positioned for improvement. Many investors focus exclusively on artificial intelligence, but Broadcom generates revenue from several semiconductor and infrastructure software businesses that could recover alongside broader technology spending. That means investors are not simply buying one growth engine. They are buying a business with multiple opportunities contributing to long-term earnings expansion. Valuation also deserves attention. Despite its leadership across several critical AI infrastructure markets, Broadcom currently trades around 19.5 times forward fiscal 2027 earnings estimates. Considering the company's expected earnings growth, expanding AI exposure, and durable competitive advantages, many investors would argue that valuation remains attractive. Markets often reward businesses capable of producing sustained earnings growth over many years. Broadcom appears to possess exactly those characteristics. It benefits from structural demand rather than temporary excitement. Artificial intelligence infrastructure spending continues increasing because organizations are still building the foundation required for widespread AI adoption. That investment cycle could extend well beyond the next few quarters. One factor that gives me additional confidence is Broadcom's ability to solve extremely difficult engineering problems. Its relationships are built on expertise rather than price competition. Customers depend on Broadcom because developing custom AI chips and high-performance networking solutions requires years of experience, specialized talent, and enormous research investment. Those barriers make it difficult for competitors to take meaningful market share. That creates a durable competitive moat capable of supporting long-term profitability. As investors, we should always ask one important question: can this business remain essential 5 or 10 years from now? For Broadcom, I believe the answer is yes. Artificial intelligence models will continue becoming larger. AI agents will require greater computing power. Data centers will continue expanding. Networking demands will keep increasing. And organizations will continue seeking custom hardware optimized specifically for their own AI workloads. Broadcom sits directly at the intersection of every one of those trends. Rather than chasing the latest AI application, it provides the infrastructure enabling those applications to exist. Historically, companies supplying the picks and shovels during major technology revolutions have often produced remarkable shareholder returns. Broadcom appears well positioned to continue benefiting from that same dynamic as artificial intelligence spending accelerates throughout the remainder of this decade. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second AI stock is SK Hynix, ticker symbol SKHY. When people think about artificial intelligence, most immediately picture powerful graphics processors. But there is another piece of technology that every advanced AI system depends on just as much, and without it, those processors simply cannot perform at their full potential. That technology is high bandwidth memory. Think about what happens every time an AI model is trained or responds to a prompt. Massive amounts of data have to move between processors at incredible speeds. Traditional memory simply cannot keep up with these workloads. High bandwidth memory solves this bottleneck by dramatically increasing data transfer speeds while improving efficiency. That makes it one of the most valuable technologies in the entire AI supply chain, and this is exactly where SK Hynix has established one of the strongest competitive positions in the semiconductor industry. The company did not simply enter the high-bandwidth memory market, it invented it. Today, SK Hynix controls more than half of the global HBM market, making it the undisputed leader in one of the fastest-growing segments of artificial intelligence infrastructure. That kind of market leadership is incredibly difficult to replicate because designing advanced memory chips requires years of engineering expertise, manufacturing know-how, and enormous capital investment. Even more importantly, demand for HBM is exploding. Every new generation of AI hardware requires larger amounts of faster memory. As AI models become more complex and companies continue expanding their computing capacity, demand for these specialized memory chips continues climbing at an extraordinary pace. One of the biggest reasons investors should pay attention is the company's position inside the AI ecosystem. SK Hynix is the primary supplier of high-bandwidth memory for Nvidia's AI accelerators. That means every surge in AI infrastructure investment creates additional demand for the memory products SK Hynix manufactures. The company is also the second-largest supplier of memory used in tensor processing units, giving it another major avenue for long-term growth. This creates a powerful network effect. As artificial intelligence adoption expands, demand for advanced AI processors increases. As processor demand rises, demand for high-bandwidth memory rises alongside it. That places SK Hynix directly at the center of one of the most powerful investment trends of this decade. What makes this opportunity even more compelling is that supply remains extremely limited. Building advanced memory chips is not like opening another factory overnight. Both AI processors and high-bandwidth memory rely on extreme ultraviolet lithography equipment during manufacturing. Those machines are extraordinarily expensive, incredibly difficult to produce, and global production capacity remains limited. On top of that, manufacturing HBM consumes roughly 3 times the wafer capacity required for traditional DRAM memory. That means every company producing advanced memory faces physical limitations on how quickly production can expand. When demand rises much faster than supply, prices usually follow. That is exactly what has been happening. High-bandwidth memory pricing has remained exceptionally strong, while broader DRAM pricing has also benefited because manufacturers are dedicating more capacity toward AI-focused products instead of conventional memory. Even more encouraging is management's long-term outlook. The company believes the DRAM industry is heading toward one of the largest supply and demand imbalances ever experienced, with supply expected to remain constrained through at least the end of the decade. That gives SK Hynix tremendous pricing power. Instead of competing aggressively on price, the company has been signing long-term supply agreements without price caps. Think about how significant that is. If memory prices continue increasing over the coming years, SK Hynix participates directly in that upside rather than locking itself into fixed pricing today. That creates stronger earnings visibility while allowing investors to benefit from future market conditions. This is one of those competitive advantages that often goes unnoticed. Investors usually focus on revenue growth. Professional investors focus on pricing power. Companies capable of raising prices while demand remains strong often produce exceptional long-term shareholder returns. Another factor worth considering is valuation. Despite occupying one of the strongest positions in the AI infrastructure market, SK Hynix still trades at roughly 8 times forward earnings estimates. For a business benefiting from one of the fastest-growing technology trends in history, that multiple appears remarkably inexpensive. The market often assigns much higher valuations to companies experiencing slower growth with weaker competitive positions. That disconnect creates opportunity. If AI infrastructure spending continues expanding over the next several years as expected, investors may eventually recognize that this valuation does not fully reflect the company's long-term earnings potential. Of course, no investment is without risk. The semiconductor industry has always experienced periods of volatility. Memory pricing can fluctuate. Economic slowdowns can temporarily reduce technology spending, and investor sentiment can change rapidly. However, artificial intelligence appears fundamentally different from previous technology cycles because AI infrastructure has become essential rather than optional. Businesses, governments, and cloud providers are investing aggressively to build computing capacity capable of supporting increasingly sophisticated AI models. Every one of those systems requires enormous amounts of high-bandwidth memory. That structural demand could support years of growth regardless of short-term market fluctuations. Another important point investors should remember is that AI infrastructure spending is still in its early stages. Many organizations are only beginning to deploy enterprise AI systems. Agentic AI, autonomous software, advanced robotics, scientific computing, and next-generation cloud services all require dramatically greater computing performance. That means today's demand could represent only the beginning of a much larger expansion cycle. If that happens, companies supplying the critical building blocks stand to benefit first. SK Hynix is not trying to predict which AI application becomes the biggest winner. It is selling one of the essential components required by nearly all of them. That is often where the safest long-term investment opportunities can be found. Instead of betting on individual applications, investors own the infrastructure supporting the entire ecosystem. That approach has historically produced some of the biggest winners during previous technology revolutions. Whether it was internet networking, cloud computing, smartphones, or data centers, infrastructure companies frequently generated enormous shareholder value because they supplied every participant rather than competing against them. SK Hynix appears well positioned to follow that same pattern as artificial intelligence spending continues accelerating over the next several years. If the company maintains its technology leadership, continues expanding production responsibly, and benefits from persistent supply constraints, today's valuation could eventually look surprisingly inexpensive in hindsight. That combination of technological leadership, pricing power, structural demand growth, and an attractive valuation is exactly why SK Hynix deserves serious consideration from long-term investors looking for AI opportunities that still appear reasonably priced. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our final AI stock is Nvidia, ticker symbol NVDA. If there is one company that has become synonymous with the artificial intelligence revolution, it is Nvidia. For years, Nvidia built its reputation by producing the world's most powerful graphics processors. But what many investors fail to appreciate is that Nvidia has transformed itself into something much larger. It is no longer simply selling chips, it is building an entire AI computing ecosystem that touches nearly every layer of modern artificial intelligence infrastructure. That transformation is one of the biggest reasons I believe Nvidia remains one of the best AI stocks investors can buy today, especially while the valuation still looks surprisingly attractive relative to its long-term growth potential. The company's biggest competitive advantage starts with CUDA. CUDA is Nvidia's proprietary software platform that allows developers to write and optimize AI applications specifically for Nvidia hardware. Over many years, researchers, universities, technology companies, and software developers built their AI models using CUDA because it consistently delivered outstanding performance and an extensive library of development tools. That decision created an enormous competitive moat. Once millions of lines of AI software have been written and optimized for a particular platform, switching to an entirely different ecosystem becomes extremely expensive and time-consuming. Developers would have to rewrite code, retrain engineers, validate performance, and potentially sacrifice years of optimization. That is why Nvidia continues dominating AI model training today. Its hardware is exceptional, but its software ecosystem makes the business even stronger. This combination of hardware and software creates one of the most durable competitive advantages anywhere in technology. However, Nvidia has never been content standing still. The company understands that artificial intelligence is evolving beyond simply training larger language models. The next wave of AI growth is increasingly shifting toward inference. Inference is what happens after an AI model has already been trained. Every time someone asks an AI assistant a question, generates an image, creates software, or interacts with an intelligent application, inference is taking place. As AI adoption spreads to hundreds of millions of users, inference workloads are expected to grow dramatically. Recognizing this shift, Nvidia has expanded beyond traditional graphics processors by strengthening its inference capabilities through language processing technologies while continuing to improve performance across its AI hardware portfolio. At the same time, Nvidia has also entered another critical area of AI infrastructure with ARM-based central processing units. Many investors still think of Nvidia only as a GPU company. That view is becoming increasingly outdated. Modern AI systems require far more than graphics processors. Large AI clusters also need powerful CPUs to coordinate workloads, manage memory, schedule computing resources, and increasingly support intelligent AI agents capable of completing complex tasks autonomously. By expanding into CPUs, Nvidia can provide customers with a much more complete computing platform. Then there is networking. This has quietly become one of Nvidia's fastest-growing businesses. Training advanced AI models often requires tens of thousands of processors working together simultaneously. Every processor must communicate with the others at extraordinary speeds. Even tiny communication delays can reduce overall system performance and waste millions of dollars worth of computing resources. High-performance networking solves that problem. By offering networking technology alongside processors, Nvidia enables customers to build faster, more efficient AI data centers capable of scaling to unprecedented levels. That brings us to what may become Nvidia's greatest long-term opportunity. The company is evolving into a complete AI infrastructure provider. Rather than selling individual chips, Nvidia increasingly delivers integrated systems designed for specific artificial intelligence workloads. Customers can purchase processors, networking equipment, software platforms, management tools, and complete server architectures designed to work together from day one. This end-to-end approach offers several important advantages. First, it simplifies deployment. Second, it improves performance because every component is optimized to work together. Third, it deepens customer relationships since organizations become increasingly invested in Nvidia's broader ecosystem rather than individual products. That makes switching suppliers significantly more difficult over time. For long-term investors, this is exactly the kind of business evolution you want to see. Instead of defending yesterday's products, Nvidia continues expanding into adjacent markets, increasing both its addressable market and its competitive moat. Financially, the company has continued delivering remarkable growth. Revenue has expanded at an extraordinary pace as organizations around the world race to build AI infrastructure. Profitability has remained exceptionally strong thanks to robust demand, premium pricing, and the value customers place on Nvidia's technology leadership. Yet despite all of that growth, the valuation remains surprisingly reasonable. Based on analyst estimates for fiscal 2028, Nvidia currently trades at roughly 16 times forward earnings. For a company growing this rapidly while maintaining leadership across multiple AI infrastructure categories, that valuation appears far more attractive than many investors might expect. Markets often assign much higher earnings multiples to businesses with slower growth and weaker competitive positions. If Nvidia continues executing at its current pace, today's valuation could eventually prove to be an attractive long-term entry point. Of course, investors should remain realistic. Competition will continue increasing. Technology evolves rapidly. Customer spending can fluctuate from year to year. No company is guaranteed success forever. But when I evaluate long-term investments, I focus on businesses that continue widening their competitive advantages instead of simply protecting existing markets. Nvidia has consistently demonstrated that ability. Every new product generation pushes performance higher. Every software improvement strengthens the developer ecosystem. Every expansion into networking, CPUs, and integrated infrastructure broadens the company's opportunity. That is exactly what long-term compounders tend to do. Artificial intelligence is still in its early innings. Many businesses are only beginning to integrate AI into daily operations. Healthcare, manufacturing, finance, transportation, cybersecurity, scientific research, education, and countless other industries are still building the infrastructure required for widespread AI adoption. That means demand for advanced computing power could remain strong for many years. Rather than viewing Nvidia as a company that already won the AI race, I think investors should view it as a company that continues expanding the size of the race itself. Every new AI application creates additional demand for computing infrastructure. Every increase in computing demand expands Nvidia's long-term opportunity. When you combine that with a powerful software moat, expanding product portfolio, leadership in AI networking, and a valuation that still looks attractive relative to future earnings growth, Nvidia deserves its place among the best AI stocks investors can buy while they are still reasonably priced. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I would love to hear from you. Which of these three businesses do you believe has the strongest long-term competitive advantage? SK Hynix, Broadcom, or Nvidia? Let everyone know in the comments and tell us which stock you are most confident holding over the next 10 years. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.